Mara, 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 how I wish you were better. If you guys are unfamiliar with who I am RexFinance, a 21-year-old kid with a weird passion for the stock market, investing in finance and things like that. But if you think that's pretty cool, hit the subscribe button for me down below. It makes my day. Also hit the like button and comment below for the YouTube algorithm. You know the rules here. But today I'm going to be discussing why I am staying far, far away from Marathon Digital, ticker symbol MARA. They are the most well-known Bitcoin mining company out there, but man, do they have some issues that I want to talk about today. But in order to get any sort of value out of this video, we have to break something down very, very quickly. In the Bitcoin mining industry, there are two different groups of companies. One is infrastructure first, the other is a self-proclaimed asset light model. Asset light, infrastructure first. There's the two groups right there. Infrastructure first is exactly what it sounds like. These companies such as CleanSpark go out and acquire their facilities. They own their own facilities. They own their own mining rigs, and they deploy their mining rigs in their fully owned facilities and start mining out of them. The asset light approach is what a company like Marathon Digital does, where they go out and buy hundreds of thousands of mining rigs, and then they need to find a host, somebody else that owns the facility that will rent them the space to mine Bitcoin out of. That's essentially what it breaks down to. Let's just get this out of the way. Marathon has had numerous problems with being an asset-light company over the past 5 years. I think they entered the Bitcoin mining space in 2017, maybe 2018. Don't sue me if I am wrong, but some time frame in that range. And as a result of their struggles with being asset-light, this company has been by far the worst in the entire industry at setting out projections and guidance and undercutting it when the actual results come in. I don't think they've met a single projection in the company's history. I'm not even trying to exaggerate. I think that's factual. Now, to be fair to Marathon, despite all of these issues and challenges that have built up through the years, their stock chart looks a lot like basically every other Bitcoin mining company stock chart out there over the past 5 years. It looks a lot like the FTT token, the token that caused FTX all their problems. It looks like a big pump and dump. Marathon stock is down 89.5% from their all-time highs that were set just about a year ago to the day. So because Marathon is 100% asset light, they obviously had a hosting partner, which is what I talked about at the beginning of this video. And in that agreement, when that joint venture was formed, Marathon signed on for a power cost of basically 4.5 cents per kilowatt hour, which is a really, really good rate on paper. It looks fantastic. However, if you guys are somehow unaware, their hosting partner, Compute North, went bankrupt very, very recently. And they've sold their assets in bankruptcy court to two different companies so far. The first being $1.5 million in assets for, I think, 11 containers. Yep, 11 containers to Crusoe Energy Systems. And the other purchaser was actually their former lender, Generate Capital, who bought two of their mining facilities for $5 million. This was Marathon's main host, Compute North. And unfortunately, as a result of Compute North's bankruptcy, in their most recent quarter, Marathon Digital had to write down an impairment of $39 million. The stinger here is they potentially have another $42 million of impairment they need to account for in future months. They're holding on hope that they won't have to do so, but right now it looks pretty likely they will. It breaks down as $10 million for convertible preferred stock to Compute North, $21 million in an unsecured senior promissory note to Compute North, $50 million in operating deposits that they're probably going to have to say bye-bye to. And we can see, I'm no mathematician, that these three numbers here break down to $81 million. They wrote off $39 million. So in future months, potentially even this next quarter, they're going to have to account for an impairment of $42 million more on their balance sheet. So yes, 4.5 cents for power sounds great on paper, but when you have $82 million of assets tied up in this company to secure 4.5 cents per kilowatt hour, all of a sudden it doesn't look so good. When Marathon and Compute North originally formed their joint venture, yes, 4.5 cents, 4.4 cents per kilowatt hour or something like that. But Marathon also gave up, I think, 18% per mining rig that they owned to Compute North. They also wrote out a non-recourse 0% interest loan to Compute North, a bridge loan to help them build their facilities. All of that is money they're not going to get back. So yes, 4.4 cents per kilowatt hour, fantastic on paper, but when you dive into everything that went into that, we start to get concerned here. And that's not even the biggest reason we need to be concerned here for Marathon. Sure, it sucks. They're going to write off $82 million in assets for impairment charge because of this bankruptcy. But anybody that comes in and purchases Compute North's assets in bankruptcy court is theoretically going to have the power to kick Marathon Digital out of their facility overnight. And if that happens, because Marathon is asset light and they don't own a single facility, their mining rigs are going to be in limbo, not producing Bitcoin until they can find a different party. The very reason Compute North went bankrupt is because they offered power to Marathon Digital for 4.4 cents per kilowatt hour, but because energy prices have skyrocketed over the past year, they are now buying their power for more than they are selling it to Marathon for. That does not make financial sense. That is why Compute North had to go bankrupt. I honestly can't think of a single host out there, hosting provider for Bitcoin mining companies that is profitable right now, unless they have a fixed power purchase agreement and have yet to really see the negative consequences of the increased energy prices. If you still don't get the big problem here for Marathon, it's that anybody going out to buy Bitcoin mining infrastructure or data centers in this current climate with increased energy prices across the board is not looking to be a host. Being a host makes no financial sense right now. Nobody wants to be a host. It is money losing right now. So anybody coming in to purchase Compute North's assets likely does not want to be a host provider. They probably want to mine their own Bitcoin. And if that's the case, goodbye Marathon. Go find somewhere else to mine your Bitcoin. The only other plausible outcome here is that whoever buys these assets reworks this agreement with Marathon and increases Marathon's cost per kilowatt hour so that they can end up making a profit in the first place, so they're not money losing and aren't forced to go bankrupt like Compute North was. That is the only other plausible outcome. So Marathon Digital's margins are either going to shrink significantly as a result of this, or they're going to be given the boot and they're going to have to find somewhere else to mine their Bitcoin and transfer their mining rigs. To make this even worse, BitNile, another Bitcoin mining company out there, is suing former and current executives at Compute North for fraud. That doesn't look good at all. However, we need to give credit where credit's due. Marathon's management team likely saw troubles coming for Compute North, and on July 18th, they signed an agreement with Applied Blockchain for 200 megawatts and a 5-year hosting contract. They found another host. But this host is potentially even worse than Compute North. Let's think back really quickly to Marathon's current projections and guidance. If I'm not mistaken, they want to reach 23.3 exahash per second by the end of next year, by the end of 2023. Thankfully, Applied Digital is a public company, so they have public financials, and I went in and looked at their most recent 10Q that was released on October 12th, and found that they have negative working capital of $6.3 million. They had negative working capital. Remember, at this point, Applied Digital, it was known as Applied Blockchain at the time. It's called Applied Digital now. They changed their name. Is the sole host for Marathon Digital. Marathon Digital is entirely reliant right now on a company that had negative working capital last quarter in order to meet their projections and guidance. Now, if we go to Applied Digital's most recent 8K filing, which came out on November 14th, we can see that the company is going to take out a term loan for $15 million. This is Applied Digital taking out this loan. The loan will be advanced in 16 different installments for working capital needs for the borrower's data center in Garden City, Texas, the Garden City facility. The reason this loan is going to be paid out in 16 installments is because Applied Digital is going to build 16 new buildings. If Marathon has any hope of reaching 23.3 exahash by the end of next year, Applied Digital needs to build these facilities and buildings, and they need to do it fast. They have what? 12, 13, 14 months to get this done. But this doesn't end here. This gets even worse. By the way, I don't know what happened to this SEC filing. I don't know if their copy machine broke or whatever, but some of the words are halfway cut off, whatever. The reason this gets worse is because the loan is secured by the leasehold interest on the Garden City facility, a security interest in substantially all of the assets of the borrower. All of the assets of Applied Digital have been collateralized for this $15 million term loan. A security interest in the form of a collateral assignment of the company's rights and interests in the master hosting agreements related to the Garden City facility, and records and data relating thereto, and the company will unconditionally guarantee the borrower's obligations to the lender, including under the loan. Would you like my left foot as collateral as well? Applied Digital has signed off every single asset they have in order to be able to take out this loan, to build these facilities they need to build, in order to host Marathon's 23.3 exahash per second. This is my biggest problem, and this is why I am making this video. I am frustrated, I have been with Marathon forever. Their management team has never been transparent about their projections and guidance. If they were smart right now and transparent, they would come out and say that the prospects of them reaching 23.3 exahash per second at this point, based on their hosting capacity they have and Compute North going bankrupt and Applied Digital not doing very well financially either, we're probably not going to reach that number. But they're not going to come out and do that. Instead, what they've done is they've doubled down on that number. They have doubled, tripled, quadrupled, quintupled down on 23.3 exahash per second. Now, it goes deeper than all of those problems I just laid out for me. Right now, I'm going to look at my Excel spreadsheet. This is the light version of what's going to be a huge due diligence file for my paid members. You can join my membership for, I think, $3 per month over on Patreon, but there's only 5 spots left for that price point. Other than that, it's like $5, $10, $15, depending on what tier and benefits you want. But I pride myself on providing my members more value than anybody else and for a much cheaper cost. So if you're interested in joining and getting access to all of my due diligence files and things like that, my spreadsheets like this, simply hit the join button down below located right next to the subscribe button, or you can go to my pinned comment where I will leave a link to my Patreon page. If you're lucky enough, maybe you'll be able to join for the $3 a month. I think there's only like 5 spots left. In this light version of my master due diligence file, I have 3 companies: Marathon, Riot, and CleanSpark. In the big version, the full version of this file, I have gone through hundreds and hundreds of press releases from every single publicly traded Bitcoin mining company that releases monthly production updates, and I have inputted that data into this spreadsheet. And we can break this down: efficiencies, growth, profitability, consistency. We can see it all in this spreadsheet. So let's start with Bitcoin production between these 3 companies. Again, the light version of this file for now. It's all I've released to my members. Full version coming, hopefully beginning of December. But with Bitcoin production, Marathon is this orange line, Riot Blockchain is the blue line, CleanSpark is the green line. Marathon Digital has by far been the most inconsistent when it comes to their Bitcoin produced. Now yes, over the past 3 or 4 months, they have been growing tremendously. But if they end up having struggles with Compute North, which I think they will, and if they have struggles finding new homes for their mining rigs, this inconsistency here is going to continue. This green line is the company that I own, CleanSpark. They have been very, very consistent. We can break this down into more consistency measures, exahash per second, through the last 2 years. CleanSpark, again, most consistent. Marathon, again, most inconsistent. Same thing for the number of miners active. And then we can go into the efficiency metrics, Bitcoin per exahash. CleanSpark mines more Bitcoin per exahash. They mine the most Bitcoin per exahash they have operational. Marathon is in second place currently. If we go to Bitcoin produced per mining rig, CleanSpark also is in the lead here. Efficiency, number 1. Marathon, number 2. And again, Marathon by far the most inconsistent when it comes to these efficiency metrics. We can go to miners per exahash, which basically all 3 of these companies are the same. CleanSpark is actually in last place when it comes to this. They have more miners operational per exahash, so they're last in efficiency when it comes to this. Marathon's still in second place, and they've been the most inconsistent. Riot Blockchain is actually in first place when it comes to this efficiency metric. But if you're a member, you have access to this Excel file. You can go through all of these individual tabs here. But in this video, because I know a lot of you don't have access to this file, I'll look at Marathon in particular. We can focus on year. Let's go to 2021 for Marathon, and let's go to Bitcoin produced. Their Bitcoin produced in 2021 was, again, pretty inconsistent, but it grew pretty well. Let's go to an efficiency metric like Bitcoin per exahash. Over the course of 2021, their efficiency fell. Let's switch the year to 2022 for fun. In 2022, their efficiencies have fallen even more than they did in 2021. Now, a lot of that is normal because the difficulty rate has gone way up to mine a Bitcoin. It makes sense. But if we let's go to CleanSpark in particular, their yearly, and let's go to 2022, and let's go to Bitcoin per exahash, we can see that they have managed this much, much better. By the way, these zeros in November, December, simply because we don't have data for the last 2 months of 2022 yet. I'm not a fortune teller, I can't see the future. So that's why there's zeros here. It's that way for every company in 2022. If I switch Riot to 2020, I keep missing the arrow. If I switch Riot to 2022, same thing, goes to zero. But you can see here, outside of all the issues I laid out earlier in this video, it just doesn't make much sense to me to own Marathon. As an investor, I want to see consistency, efficiency, and growth. When it breaks down between those 3 different metrics, Marathon, out of these 3 that I have in this light version of the spreadsheet, is probably in last place. Riot Blockchain is in second place, and CleanSpark is in first place, which is why I own CleanSpark. These things matter to me. This due diligence will always matter. No matter what the market tells you today, it doesn't really matter. I'm confident that CleanSpark is going to outperform in the future. Now, I want to make this clear. This video is not me saying buy CleanSpark, sell Marathon. I'm simply making this video because I think Marathon needs to be much more transparent about the challenges they've had and probably the challenges they have into the future. They have not been transparent about that at all, and I think they owe that to all investors and the stock market community in general. They owe that to us, and they don't do it. That's why I'm trying to bring these issues to the forefront so that hopefully Marathon thinks, oh, maybe we should pay more attention to that because people are actually finding this out. Anyways, I'm going to end this video here. If I had to guess, Applied Digital is going to suffer the same fate that Compute North did. They're probably going to go bankrupt because they have major financial issues, and Marathon is reliant on these companies with major financial issues to reach their 23.3 exahash per second by the end of 2023. I see it as extremely unlikely, as it stands today, that Marathon will be able to accomplish their goals. Again, that would be nothing new for the company. The management team has always overpromised and underdelivered. That is a terrible thing to do in the stock market. If you're a management team or an executive out there, underpromise and overdeliver. Don't do the opposite. With that, I'm going to end this video here. I hope you guys enjoyed this. If you did, leave a like down below. Comment for the YouTube algorithm. If you're new here, returning not yet subscribed, please subscribe down below. It makes my day. Have a great rest of your day. Stay blessed. 10 toes to the ground. Chin up. Peace out.